Every annuity makes the same promise one day. One day it'll be there when you need it. But every promise depends on one thing, the company making it. Recently, I watched an interview with former insurance examiner and certified fraud examiner, Tom Gober. After spending more than 40 years examining insurance companies, there was one statement he made that completely stopped me.
Even if you have the perfect life insurance product or annuity, it's designed just right for your customer. What good is it if the insurance company dies before your client does?
I agree.
It suddenly goes from a great product to a worthless product.
Right.
And that's a huge problem.
Think about that for a second, because that's a question most people never ask. When someone buys an annuity, they usually compare interest rates, bonuses, income riders, maybe even the company's ratings. But very few people stop and ask, how strong is the company making the promise? That's the question Tom has spent more than 4 decades trying to answer. And one company he keeps coming back to is Athene. Now, before we go any further, this video is not claiming Athene is going bankrupt. We're not accusing anyone of fraud, and this is not financial advice. Our goal is much simpler than that. We're going to hear directly from Tom Gober, look at the same public financial filings he discusses, and explain in plain English why he believes Athene deserves a closer look. By the end of this video, you'll understand the 3 concerns Tom raises, what they mean, and the questions every Athene policyholder should be asking. Before we look at Athene, you should know why people listen when Tom Gober speaks, and why his opinion carries so much weight. Tom didn't spend his career selling annuities. He spent it examining insurance companies for more than 40 years. He worked as an insurance examiner, later became a certified fraud examiner, worked alongside the FBI, helped investigate insurance fraud, and testified before government agencies about problems he believed were developing inside the insurance industry. His job wasn't to market products. His job was to find problems. And according to Tom, the concerns he's raising today are not new. They're the same warning signs he's been talking about for decades.
People are starting to say, Gober, you're right, or you've been right. What are they referencing about you being right about?
The big issues, my greatest concerns, the things that I've been watching beginning 41 years ago as a young examiner. I learned how companies are supposed to report, and it's supposed to be truthful, and it's supposed to be transparent. And over the last 4 decades, it has headed the wrong direction.
That's an important distinction. Tom isn't saying every insurance company is unsafe. He's not saying every annuity is bad. He's saying, after reviewing insurance company financial statements for more than 4 decades, he believes some companies have become far less transparent than they used to be. And one of the companies he repeatedly points to is Athene. Now, before you dismiss that, there's something else you should know. Athene isn't a small insurance company. It's one of the biggest annuity companies in America. According to LIMRA, Athene has led the industry in fixed indexed annuity sales since 2020 and has ranked among the nation's largest annuity providers in recent years. So this isn't a story about some obscure company no one's ever heard of. It's about one of the biggest names in the business, which raises an obvious question. Why would Tom single out one of the industry's largest and most successful companies? According to Tom, he believes that Athene's own public financial filings illustrate several trends he's been warning about for years. Let's hear the 3 concerns he says stands out the most.
The greatest concerns are very thin levels of capital. We call it surplus in the insurance industry. We also have some very high risk assets that have been introduced. They've been doing it for a while, but it's caught more attention lately. Private credit, private equity. Another issue is what they call offshore reinsurance and captive reinsurance. We'll talk about what reinsurance is, but it's laying off of risk is what they're supposed to be doing. That's supposed to be transparent, and we now have several $1 trillion worth of reinsurance that I can't see the other end of the transaction.
Those are the three concerns we're going to focus on today: thin surplus, complex investments, and offshore reinsurance. We're going to look at each one using the same public financial filings Tom references and explain them in plain English. Because if Tom is right, understanding these three issues could completely change how you evaluate an insurance company. So let's start with the first one: surplus. The first thing Tom points to is Athene's surplus. Now, if you've never heard that word before, don't worry. It's actually one of the easiest concepts in this entire video. Think of surplus like an emergency fund. After an insurance company accounts for every promise it's made to policyholders, whatever financial cushion remains is called surplus. According to Tom, that cushion is one of the most important numbers on an insurance company's balance sheet. Let's hear him explain why.
Surplus is that only buffer above all your promises. So assets minus liabilities equals surplus. That's your buffer, and it's the only amount between an insolvent company and a solvent company. So that buffer, the NAIC wants it to be comfortable. The industry should have a buffer that can handle write-downs in these risky times.
That's really the key idea. Surplus isn't money that's sitting around doing nothing. It's the financial cushion that's there if investments lose value or something unexpected happens. So naturally, the larger the cushion, the more room a company has to absorb losses. The smaller the cushion, the less room there is for error. So, what did Tom find when he looked at Athene's balance sheet? According to Athene's 2025 statutory financial statement, the company reported more than $336 billion in liabilities, backed by approximately $4.1 billion in surplus. Tom calculates that to be a surplus ratio of about 1.2%. He also points out that the overall industry average is closer to 7%. While some long-established mutual insurance companies carry significantly larger surplus cushions. Let's hear Tom explain why that difference caught his attention.
If you divide surplus 4.1 by liabilities of 336.63, you're going to get 1.22%. 1.2% is the buffer for that much liability exposure. The national average at year-end 2025 was like 7.03%, and unfortunately, that 7.03 has been pulled down because by some of these larger companies having far less. The fact that it's 1.2% against a national average of 7%, but the more prudent traditional companies, New York Life, Teachers Insurance, the Guardian, another great mutual, the real mutuals have 15, 20, 25 billion, up as much as 20% in surplus to liabilities. At the top, I say razor thin for a reason. That's very little buffer, because if you think about it, for every asset that's on their books, if it has to be written down $1, that has to come out of surplus. So if you've got 300 billion in a lot of which is higher risk stuff, it takes very little write down to eat up that 4 billion.
Notice what Tom is not saying. He is not saying Athene is insolvent. He's not saying policyholders are about to lose their money. His concern is much more specific. He believes Athene has a relatively small financial cushion compared to the promises it's made. Whether you agree with that conclusion or not, that's the concern he's raising. But here's where Tom says the story becomes much more interesting, because according to him, the surplus number isn't the biggest issue. His biggest question is this: how much of Athene's risk has been transferred somewhere else, and where did it go? That's where Tom believes the investigation really begins. If Tom's concern were only that Athene has a relatively small surplus, this would be a much shorter video, because Tom believes the next question is even more important. If an insurance company transfers part of its risk, where does that risk actually go? That's where something called reinsurance comes in. Now, before anyone hears that word and assumes it's a bad thing, Tom is actually very clear. Reinsurance, when it's done correctly, is one of the reasons the insurance industry has worked so well for generations.
Reinsurance is also an excellent thing if done properly. It enables a company to share some of the risk with another independent party. Reinsurance has been my primary focus for 41 years. I have to tell you, in the early years, they ceded or transferred reinsurance to real reinsurance companies that were unaffiliated, that not only were willing to take the risks, but had the money to honor the payment. And legitimate reinsurance is a great thing. Right. It makes the world go round, frankly.
That makes perfect sense. Imagine two insurance companies. One company has taken on more risk than it wants to keep by itself. So it transfers part of that risk to another independent insurance company. Now, both companies share the responsibility. If one company experiences unusually large claims, it isn't carrying the entire burden alone. That's how reinsurance has traditionally worked. And according to Tom, it's an important part of a healthy insurance industry. But then he says something's changed.
But over the last several decades, there has been a dramatic migration away from independent reinsurance to reportedly transferring the liabilities from the main insurer to someone else, and unfortunately that someone else is an affiliate or even a direct subsidiary of the insurance company. So you're not going to an outside independent reinsurer that knows what they're doing. You're going to a sister. You're moving liabilities from one pocket to another, or like I say, you get a box of claim files from the file room and move them down to the basement. I don't see him doing much more than that in these transactions.
That analogy is really the heart of Tom's concern. Imagine you move every important file in your office from a filing cabinet everyone can inspect into a locked room in the basement. The files still exist, nothing's disappeared, but it becomes much harder for everyone else to see exactly what's there. That's the point Tom is making. He's not saying reinsurance itself is bad. He's saying when large amounts of risk are transferred to companies that are closely affiliated, especially companies outside of the United States, it can become much more difficult for outsiders to evaluate exactly what's backing those promises. So naturally, that raises another question. Is that actually happening at Athene? According to Tom, the answer is yes. And he says Athene's own public filings show why.
If you'll look where I have yellow highlighting, on the left at the upper, you'll see it says reinsurance ceded. That means transferred out of Athene Annuity into someone else. Here's what worries me about this particular reinsurance portfolio. If you look, the first couple of lines are affiliates, Athene Life of New York and Structured Annuity Re. Those are a couple of regular insurance companies. The next group, all four contracts are with Athene Re USA 4 in Vermont. These are those secret captives, but even that's only $1.2 billion. So the first 2.2 is not too bad. But then look at the next section. If you'll look in column 4, name of company, all of those contracts are with the same company, Athene Annuity Re Limited, and they're offshore. They're in Bermuda. That section totals to $110.3 billion.
Oh my goodness.
In modified coinsurance, ModCo they call it. But then look, if you go to the bottom, same Athene Annuity Re Limited, and look at that, $65.26 billion in column 9, just 2 contracts. And that's column 9, reserve credit taken. Reserve credit taken current year is everything. That tells you how much has Athene Annuity subtracted from its liabilities because someone else is on the hook. Remember earlier I gave the example in a legitimate deal, you can subtract the 10 because the other company is going to set up the 10.
Correct.
Here, they've subtracted $65.25 billion just with this group, but we don't know what's on the other end. We don't know if there's $65.25 billion to cover that. But then look, you've got more Modco, again, $5.7 billion. This one page, they have $66.5 billion in reserve credit and $116 in Modco, all with their affiliates. But look, I conclude the Schedule S part with the totals. And I just want to point out one thing that I consider very significant. Notice that all combined, $168 billion in Modco and $67.5 in reserve credit. That totals to $242 billion. That's total ceded to any company. But look, 236 of that is all with their offshore affiliate. So 97.5% of their reinsurance is just internal. It's not to an outside party with its own money that files with the U.S. It's not just that they have 97.5% with only one reinsurer, which is silly. Why not spread it? That's the whole idea. Traditional companies, New York Life, they have reinsurance with all kinds of real companies that they're not affiliated with. They have zero of this. So if you look at this, because you're not used to this, you might think, well, maybe that's what companies do. It's not. 97.5% of all of their reinsurance is not only with just one company, it's one company that is an affiliate. And that affiliate is offshore. It doesn't get much less transparent than that.
Again, Tom isn't accusing Athene of breaking the law. He's not claiming those transactions are fraudulent. He's pointing to the company's own filings and asking whether this level of affiliated offshore reinsurance provides enough transparency for policyholders. Whether you agree with Tom's conclusion or not, that's the question he believes deserves more attention. But there's one more piece of the puzzle. Because even if you understand where some of the risk has been transferred, you still have to understand what's backing the promises in the first place. And that's where Tom turns his attention to private credit and something called CLOs. If you've never heard the term CLO before, you're definitely not alone. Here's the simplest way to think about it. Imagine a bank makes hundreds or even thousands of loans to businesses. Instead of keeping every loan on its books, those loans are bundled together and sold as an investment. That bundle is called a collateralized loan obligation, or CLO for short. Now, owning a CLO isn't automatically a bad thing. Insurance companies, banks, and large institutional investors have owned them for years. Tom's concern isn't that Athene owns CLOs. His concern is how much exposure these companies have to complex investments that can become difficult to value or sell during periods of financial stress. Let's hear Tom explain it.
We also have some very high-risk assets that have been introduced. They've been doing it for a while, but it's caught more attention lately. Private credit, private equity. My biggest concern is that a lot of them are assets that don't have a good market. You can't get a good market quote on a lot of it. So we don't know how quickly they could be sold to pay claims. So when private equity got involved, I started seeing the portfolios of investments change radically over a period of years. You see that the private equity group takes control of a company that had, like you said with Ohio National, they were a great company. These were companies that had real assets, but over time, the better, more liquid stuff like treasuries and tradable bonds disappeared and were replaced with much higher risk, far less liquid investments.
Notice something important. Tom never says these investments are guaranteed to fail. He never says they're worthless. His concern is liquidity. In other words, if an insurance company suddenly needed cash, how quickly could those investments actually be converted into cash? That's a very different question, and it's one Tom believes deserves more attention. Now, Tom isn't the only person who's raised questions about these investments. One of the documents comes from the Federal Reserve. The report discusses how some life insurance companies increase their exposure to CLOs through affiliated asset managers. Now let's be very clear about what that means. The report does not say Athene is insolvent. It does not accuse Athene of wrongdoing. And it does not say policyholders are in immediate danger. What it does show is that federal economists consider these investment structures important enough to study. Not necessarily about one investment, but about transparency. Can policyholders clearly understand what's backing the promises being made? That's the question Tom believes every retiree should be asking. So, after everything you've heard, what should you actually do? If you own an Athene annuity, does Tom believe you should panic? No. In fact, that's not what he says at all. Throughout the interview, Tom repeatedly comes back to the same point. He believes policyholders deserve more transparency, and before anyone buys an annuity or decides to keep the ones they already own, they should understand the financial strength of the company making that promise. One of the questions Caleb asked Tom was simple. If someone is considering an Athene annuity, what should they ask? Let's hear Tom's answer.
Let's say that an advisor says, hey, you should buy this Athene annuity. Policyholder should ask the advisor. I was told that they do a lot of offshore reinsurance and that it's not really transparent. Could you get for me, the policyholder, the total amount ceded offshore or to secret captives? We want to know how much reinsurance that's internal and compare that with surplus. And you could actually say line 38 from the balance sheet,
You
right?
sound really smart. Your advisor's going to look at you like
The advisor is not going to know the answer, but that's what's so important. The advisor would then have to reach out to the company, and the company would go, why are these agents asking this? And they'd start to realize that people care about what's in these financial statements.
Whether you agree with Tom's conclusions or disagree with them, I think that's reasonable advice. Ask questions. Understand the company behind the promise. And don't assume every insurance company manages risk the same way. Because one thing Tom makes very clear throughout the interview is that not every insurance company is the same.
There are a lot of large mutual insurance companies and a lot of fraternals. There are great fraternals and mutuals, and they don't use any sleight of hand, reinsurance, pretend, creating fluff.
This video wasn't made to tell you what to do, and it certainly wasn't made to scare anyone. It was made because retirement is built on promises, and every promise depends on the financial strength of the company standing behind it. Tom believes Athene's public financial filings raise questions that deserve to be examined. You may agree with him, you may disagree with him, but after spending more than 40 years examining insurance companies, working alongside the FBI, and reviewing thousands of pages of statutory financial statements, I think his opinion is worth hearing. And ultimately, that's all this video set out to do. Present the concerns, show the evidence Tom relied on, and let you decide for yourself. If you would like a second opinion on your current annuity, or simply want someone to help you understand the financial strength of the company behind your retirement, we've included a link below where you can request a complimentary review. No pressure, no obligation, just an opportunity to ask questions before making one of the biggest financial decisions of your retirement. Thanks for watching.